And we welcome from Goldman Sachs Asset Management a gentleman that should be here now, Jim O'Neill. Jim, good noon to you.
Hey, Tom, how are you? I hope you're keeping everybody in Washington under control.
Well, we're keeping them under control, but there is a certain tension. I want to divide this discussion, Jim, into the BRICS later in Asia, but much more now the idea of coupling and decoupling. Define for us what coupling and decoupling is.
Well, to translate that into practical terms, I think the most important thing is what happens to Chinese inflation in the next couple of months, and certainly in the run-up to the G20. It's very interesting to observe what Christine Lagarde has been saying yesterday and today, and calling for the spirit of the spring '09 G20. And I suspect that when we move up to the November one, which will obviously centre around some support or stronger policies out of Europe, if Chinese inflation has peaked, China can be one of the few countries that can comfortably reduce interest rates and show more leadership. And when I hear people talking about recoupling of the world again the past few days, I really don't know what people are talking about. It's blatantly obvious that the bigger emerging, or what I'd call growth economies of the world, are facing a different challenge than that of the West. And maybe all of this mess is going to help them, because it will bring the peak in inflation earlier than it otherwise would have been, because commodity prices have gone down.
Right. Well, there's the opinion of Jim O'Neill. There's another view out there. This is the middle ground. Earlier this morning on Bloomberg Surveillance, Sirius and XM nationwide, worldwide on Radio Plus, I spoke with Robert Sinch of RBS Securities, and I asked Bob Sinch if the BRICS and our economies coupled together, or had they decoupled, as Jim O'Neill suggests.
In one sense, the world is decoupled in that Europe and the U.S. could grow at 2% or less, and Asia could still grow at 8%. But relative to their potential trends, that might be a little bit below average or below trend for all of them. So there's a coupling, but also big divergences in terms of potential growth.
And there is Bob Sinch. I mean, Jim O'Neill, this is a nuance here between decoupling. Bring up the inflation chart, Rex, if you would, and this Chinese inflation. And you can really see over a good number of years that surge, and then down we go. Jim O'Neill, what is the character of Chinese inflation?
Well, the central bank did formally raise their target for inflation for this year to accommodate some of the increase in commodity prices and wages, but they want to keep it in a 3 to 4% area as a trend, and it's critical, more critical than people seem to realise, and a lot more important than the exchange rate issue in terms of helping them spread the rising affluence and the role of their consumer, and that's a central part of the 5-year plan. And it's extremely important. And following up on what I heard Bob was saying to you earlier, you know, Chinese growth in this 5-year plan is all about better quality of growth rather than just the quantity. And the days of China growing at 10% and beyond, I think, are behind us. But that shouldn't worry people. It means China's going into a better balanced and more sustainable rate of growth, which at the kind of level of Chinese GDP is really good for the world. You know, we're talking about an economy here of $6 trillion that, if it manages to do that, will be creating in dollar terms effectively another South Korea every 12 months or half a United Kingdom every 12 months. And the relevance of them to helping the West get out of its challenges becomes more and more important.
We speak with Jim O'Neill, of course, with Goldman Sachs International, now with Goldman Sachs Asset Management. Let's bring up, Rex, one of the notes from Jim O'Neill. This is the ideas coming off his desk after a busy number of weeks of travel. Growth markets will represent about 4 times that of the U.S. and around double that of the U.S. and the Euro area put together. This is, Jim, this idea of the emerging markets just leaving Europe behind. With these European challenges, is Europe being left behind over the next 10 years?
Well, I think in a strange way, if the growth markets do show the kind of growth we're talking about, they might end up bring Europe out of its mess. But on a relative basis, yeah, definitely. What one would hope that from the intensity of pressure facing some European countries here, particularly the Club Med ones, they will finally adopt some genuine supply-side reforms. Because if they don't, then they're going to get left way behind, that's for sure.
Let's bring up euro-yen here, that polarity. Take out the dollar, folks, and look at euro-yen. And you see here on Goldman Sachs, away from Jim O'Neill, calling for a strong euro and a weak dollar. Look at that chart back to the 1980s, and you can see the strong yen coming down through the boom 80s. We've rolled over again to a further strong yen. Jim O'Neill, is this a strong yen or is it a weak euro?
I think it's a bit of both. You know, the foreign exchange market remains a bit of a dance of the least ugly sister, and with the Swiss franc having been taken out of the equation, the yen seems to win by default. But I'm in the camp that thinks the yen strength is pretty ridiculous, and I think the Swiss authorities have demonstrated a bit of an important lesson to some countries about how to deal with unjustified currency strength. And I know the Japanese are always timid, but I think they have to be a bit more forceful. It is not good for Japan coming out of their challenges, and it doesn't really make a lot of sense. At the end of the day, Japan's debt is not far off double that of Italy, so quite why the yen should be treated as a currency safe haven is pretty silly in my view. Jim, when you look at Europe right now, and you mentioned timid, is Goldman Sachs Asset Management, are you brave enough to invest in Europe right now? Well, we were having, as we do every other day, and I'd share a discussion with all our portfolio managers, and you know, whilst our bond guys have been correctly cautious about looking for too early of a turnaround in this mess, the reality is the more it goes on, the more real big value you do get in some of the European equity markets. And if you look at the most conservative approaches to equity valuation, not surprisingly, some of the European markets look on a global basis really cheap. So it's a brave person that dives in there, but once the European policymakers do something fundamental to put this crisis behind us, I wouldn't be surprised to see a big rally in some sectors of European markets.
Jim O'Neill, thank you so much from London. He is with Goldman Sachs Asset Management.